I'm really excited to do this session. Before we do that, before we get into it, let's get the housekeeping stuff done. Please the lawyers. So, the normal disclaimer applies. Uh, it's interesting. I always just breeze by these things. Yeah, we all understand this, but trading is a really hard business. And one of the things about this session that I'm going to talk about a lot is in the places you can simplify it and make it procedural, follow a process. Um, that's a key difference getting from hypothetical performance to real performance. But even doing that well, this is a really hard business to do consistently. So take that with a grain of salt. All right. So trading is dangerous. Don't do it. Yes, it is. It's bad for your health unless you get really, really mechanical. So anyway, welcome everyone. This is the session we're doing today. Trading ESP, little play on extrasensory perception, edge setup playbook. Those three things combined are referred to, at least in this session and in TRG language, as a process. And I'm going to talk about that in just a second. But I want to just get through some housekeeping and who's who and what are we going to try to do in this session and the subsequent 3 sessions. And then we'll go from there about specifics about what an edge setup playbook is and how to develop and use a process trading. So that's our agenda. And real quickly, who's here and who is this TRG name that I see on this slide deck? I'm Jeff Mam. I'm going to show you my bio in just a second. TRG is Trading Research Group. It's let's see. I don't like to think of it as we're an educational club is the best way to describe what we do. And there's a number of our members are here today, as well as this is open to the public. So there's a lot of folks dropping by to just check out what we're doing. So understand that. And I'm going to try along the way to sew all those things together, me, who you are, regardless of your background, and what TRG is and how it might be useful to you. And so in order to do that, that's why I decided for these 4 sessions, I'm going to do 2 free. So this one's going to be introduction and terms and stuff like that. And then we're going to get into some meat of setups next Saturday. And then the following 2 will be detail, and those will be the ones you have to have joined for. Okay, so who's in the audience? As I said, we have a number of members of TRG here. We have a bunch of people from the public with varying levels of knowledge. So I'm assuming you understand the basics of future trading. You understand, bid ask, and that futures markets are pretty transparent. There's buyer seller interact pretty easily without anybody in the middle, and that's a critical thing to consider because markets are auctions, and if you want the auction not to be influenced, it has to be everyone has to be able to see price discovery, and we'll come back to that in just a second. So my mission for today is to try to help you shorten your learning curve wherever you are in your learning curve. I've been trading for 47 years, and I still do this all the time. I'm constantly changing, improving. It's always about progress, not perfection. And so, I encourage you to try to keep an open mind. Tabula rasa is something I like to say about that. If you've been to any of my other presentations, try to forget everything you think you know and just kind of listen with an open mind. And from that point of view, I think you might find a lot of this useful. And it will become more useful the more you kind of play around with the ideas. So let's go on and talk about what that is. Real quickly, if you've been, again, to any of these sessions, I always just want to tell you my background, just so you know the point of view I'm coming from. I've been trading a really long time. I've been in business, VC, a college professor. Trading Research Group I founded in January with Lee Harris of Emoji Trading, respected prop trader, developer, coach. And we have some really, really neat members at all different levels of trading. We have funded traders, we have people in combines, we have people that they aspire to do that. We have a couple of reasonably successful professional traders. We have people that have ranches in New Zealand and all kinds of things. So I encourage you to learn more about that when we get to it. But for the purposes of this session, let's just make some assumptions first about markets. And I'm not, when I say these are assumptions that I've learned over time, they are. And for the purposes of this session, I'm going to make them assumptions. If you don't agree with me, that's fine. But I'm going to give you a chance to debate that a little bit along the way. So markets or auctions, I think most people would agree with this one, and I rarely ever get any pushback on that one, although markets don't go sideways. Keep that in mind. Technical analysis, this is where we often get pushback. People think that trends are important, or support, resistance, moving average crosses, exponential moving averages, pivots, any of that stuff. And those things are all just metrics, and they really don't mean anything other than sort of context. And that's true of charts as well. You know, if you say, well, you know, there's a support level showing on XYZ chart, I can build a chart that agrees with you, and I can build a chart that disagrees with you for any assumption you make. So really all you're doing when you're looking at a chart is you're looking at a representation of what's happened in the past. And again, that's useful for context, but where it's not useful is for predicting the future, and that's what people think you can do with it. And that's a big problem, okay? So if you just come on board here for a moment that markets or auctions, technical analysis shows potential places where something could happen, but dismiss the idea of support and resistance, dismiss the ideas of trends, and all those kinds of things, and just think about what is going on in the market at any given moment. And let's work from that point of view, and we'll see where we end up, okay? One other comment I always like to make is that all trades are scalps until they prove otherwise. And if I don't elaborate on this, people think, oh, well, he's just a scalper. I'm an intraday swing trader, so I don't need to listen to the rest of the presentation. And again, that's completely wrong. Even as an intraday swing trader, your number one most important thing you can do is get your entry right. Because if you do that, everything else works. If you don't get the entry right, then you're in trouble right out the gate. So I treat every trade as a scalp, and because of that, it's either right or wrong right away. And then if it's right and it turns out it's got potential for the rest of the day or even overnight, that's fine. But this mentality will keep you out of trouble and out of bias. And that's a really important thing in discussing edges in the market, because an edge is something that's a perception. And if it's not based on statistics, if it's just based on your gut or, you know, something you read on Twitter or whatever, obviously that's just not going to work over time. You know, it might work once or twice, but it's not a consistent way to make money in the markets. Okay, so let's talk a little bit about these concepts. And this is really the meat of what we're going to do today. And then what I'm going to do, and I'm hoping this will really be useful. Some of you have seen the process that I was using last year. I published it on Surfing the Markets and in the workshop that we did last year, the setups workshop. And that's one I've been using for like 3 or 4 years with minor variations. And so what I'm going to do is I'm going to go through these terms, and then I'm going to show you the old one and kind of how it's migrated under the current conditions to the new one. And that's really the gold nugget of this session, whether you're in Trading Research Group or you're in just coming by to see if there's anything here worth listening to. That right there is the thing that you can value and get a benefit from, regardless of where you are and who you are in the group here. So stay with me for a minute. We're going to get to that. But first, if we don't all get on the same page from terminology, then none of this is going to make sense. So ESP was just a play on words, you know, extrasensory perception. I'm a child of the 60s. I was born in 1960, grew up in the 60s, and all that stuff was going on. And I remember, you know, there was a lot of, even the CIA was doing work about, you know, remote viewing and extrasensory perception. So it was a little bit of a play on words, but it's not at the same time. Because to do this right, you really have to have a little bit of extrasensory perception, but it has to be defined. It has to be in terms of odds or something that's measurable. So edge. I'm going to pause here for a second and ask somebody. Yes, Jonathan just said intuition is ESP. It is. The difference is learning how to understand and listen to your intuition. That's what really the key is. So I want to just throw this out to the group here. I'm going to pause. I love to do interactive training. It's hard to do on Zoom with text questions, but I'm going to take a shot at it. Can somebody, and if you're in TRG and you know the answer that I might be looking for, I'm going to ask you to refrain. And if you're new to TRG or you're just a member of the group, of the public group here today, could somebody please put in the text chat something that they think is an edge in the market right now that you're doing? So, you know, if I go to you and I say, as a trader, what is your edge in the market? Can somebody just give me a sentence on what your current edge is? I'm just curious to see an example of a definition or two. And don't worry, I won't pick on you. I really just want to hear some suggestions. What's an edge? Is an edge an MACD crossover? All right, there's one, an EMA cross. Is that an edge? Let's see if there's some other examples. So an MACD cross would be another example of something similar. Moving average, you know, convergence, divergence. So you're looking at a change in moving averages, or an EMA cross would be one moving average crossing another. Anyone else want to take a shot? Are those bid-ask ratio? Okay, that's an interesting one. A statistical occurrence of something that will repeat. You guys are good. Now you're really getting on the right track. Okay, not being dependent on indicators, just reading things as they are. Numbers, bars, footprints. Good, 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 good. Okay, this is all really good stuff. RSI MACD, I love that one. Okay, trap traders. Okay, Anita, that's a very interesting one. So these are all things that go on in the market that can lead to a potential edge. Bingo. I'm sorry if I'm not going to pronounce your name correctly, but is it Vadenhouse? I hope I'm saying that correctly. Vadenhouse nailed it. Everybody else was kind of dancing around the right idea, but you nailed it. So good job. An edge is anything that improves your chance of making money. So let's talk about playing blackjack. Most people understand that in blackjack, if you count cards, you have an edge. That's why the casinos won't let you do it. Or they have a shoe with 18 decks in there. So it's impossible for a human, unless you're Rain Man, to do it, right? There are places that play with single decks, or at least there used to be. I don't know if there still are downtown or whatnot. But if they see you're anything resembling counting cards, you're thrown out of the casino. Because that's a legitimate edge. And the casino has an edge in the game based on the rules. It's tiny, it's like 1%, but it's just enough. So you nailed it. An edge is not crossovers, it's not ratios, it's not an indicator of any kind. It's not necessarily nodes or bid-ask imbalances. It's the result of the information. And if that information can get your odds better than 50-50, then you have defined an edge right there. So that bar, that's an excellent way to put it. Mark Douglas says a higher probability of one thing happening than another. Okay, so that's a really good way to do it. I'm a semi-pro poker player, so let's talk about poker. Another good example. If you're playing 7-card Texas Hold'em and you're at a table with, say, 9 people just for fun, and the best possible hands you can get are a pair of aces or an ace-king that are suited as your pocket cards, you know, the 2 down cards. And even at that moment, you have an edge, okay? Your edge is that you have one of the 2 best possible hands. But all that means, if you understand poker, is that your odds are 31% of winning the hand. So unless you bet it properly, and unless you read the other players at the table properly, you do have an edge, but it's not the automatic winner everyone thinks it is. Oh, I have a pair of aces, I'm all in. That doesn't always work. In fact, that many, many times won't work. So an edge is a statistical advantage that's, and some of you touched on other pieces of it, that's repeatable. It has to be repeatable, because if it's not an edge. You just got lucky. So Joe Hamill said, statistical occurrence of something that will repeat. So perfectly. Exactly, Jonathan. That's why in order to be a good poker player, you can't just bet the cards. The cards are only kind of the price of admission. I like ace-king better than a pair of aces because it has more possibilities. You know, for example, straight flushes. And so if I've got, you know, suited ace-king, I will bet that aggressively, but until I kind of see the other players at the table, you know, going all in and betting everything I have is a stupid move. Because, you know, there could be a guy with a pair of jacks and the flop comes and there's 2 more jacks. I literally cannot win that hand now. So if I had just waited to collect a tiny bit more information about my edge, and that's why you bet after each event. You know, you bet after the down cards, and then the flop, you bet again, because you're collecting information and you're adjusting your edge. So this is a really, really good example, and you guys are playing along, so thank you, that's working. And I think you understand the point. An edge is not gonna be, well, you know, the 100 period EMI crossed the 30 period EMI. All that is a statistic based on the past. And in the markets, there's thousands of variables. So that's not an edge, that's an event, that's a metric. And so don't confuse that at all with an edge. It has to have a consistent risk reward that's positive. Thank you. Okay, so let's move on to what is a setup. A setup is simply a trade situation based on the conditions in the market where you have a legitimate edge, and sometimes in a setup there's more than one edge. Okay, we'll come back to that. And so therefore, the odds are in your favor and you should put the trade on. It's that simple. And so a setup is based on an edge, one or more. And a lot of times people will say, well, you know, we just touched the S1 or S2 or S3 level, and you know, so I'm getting long, you know, because it's going to reverse. That's not an edge, and that's not a setup. That's a statistic. Now, if you said, okay, when we touch S3, if I see that the bid ask, somebody mentioned that earlier, that the order flow is pushing the ask up, and people are getting caught in trades and getting stopped out, that has become an edge, and therefore you have taken the order flow and an inflection point, not support or resistance, but an inflection point, that S3 or S2 or whatever it was, and sometimes it's self-fulfilling, sometimes it's not, but if those things end up being edges, great, but by definition, they alone are not, so that's important. Okay, and then last, what's a playbook? Well, it's just a collection of these. Under certain conditions, certain edges will result in certain setups. And the idea of implementing this whole thing collectively is a process. So that's my approach to the market. That's our collective approach to the market in Trading Research Group. And it works for us, both as students and as instructors and as traders. So I want to pause here for a minute and discuss and ask questions and see what questions you guys have before we go into two actual examples of this, my older one and my newer one, and how they work, and some specific setups. So can I repeat setup again? Sure. A setup is simply a situation in the market based on the time of day and the order flow and the instrument where that edge is legitimate. So a setup can have more than one edge. For example, a couple of my setups do. And so the idea of a setup is to take edges that you are aware of that are known. Remember, we just defined an edge, a known statistical advantage. And then it's a place where you implement that known statistical advantage. And there may be more than one edge there. That's something I always forget to mention, but it's very true. And the converse is true as well, Christine. You can have more than one setup occur at the same time. And that's gold. That's the ace king, the pair of aces when you get that situation, because your risk reward is just so much easier to understand. And the playbook, again, is just a collection of those things. And this entire approach is called a process. And if you talk to any successful trader anywhere at any prop firm or any hedge fund, and you ask them what the key to their successful trading is, they will tell you that they follow a process. They won't tell you that it's MACD or that it's the magic indicator they bought here or there, or that it's algo, or it's this, or it's they know what smart money is doing, or they know what big money is doing. That's all furu nonsense. Furu is fake guru. That's Twitter nonsense. Nobody does that in real life. In real life, you have a process, and in that process, you execute your edge in setups against the market. You're welcome, Christine. Okay, so any other questions or comments about this before we go on to see a few real live examples? Okay, none? All right, we will proceed. post questions as we go. Again, I'm trying to hit them, and Lee's keeping an eye on them for me as well. So, all right. So if you followed me at all or anything in Surfing the Markets or Trading Research Group, literally as of a month ago, this was the active process that I was working. And I'm 60 years old and I have some health problems. I've been trading for 47 years. I put that up in my bio. And every now and then, one of my health problems is rheumatoid arthritis. And if you don't know what that is, it's a autoimmune form of arthritis where your body basically just attacks its joints. And it's ridiculously painful. But every now and then I have to step back. And I also have to really understand if my pain is affecting my decision process. Well, anyway, a couple of weeks ago, I was having a rough time and, we were all going through quarantine and all. And so I really took a hard look at what I was doing here. And I'm going to explain this in just a minute, what this, all these little boxes mean. And I realized that there was a better way to do it, particularly under the current market conditions, which are, really volatile and price discoveries going on all the time. And, CL contract went negative $37. Look, I've been trading for 47 years, literally. That's not an exaggeration. And I've traded options and futures and stocks and everything you can imagine. I've seen every event except the crash of 29, every significant event since then, the crash in 87, Black Monday, Black Friday, the Asian financial crisis, the dot-com bubble, the 2007, 8, 9, 10 Great Recession. And I've seen events like we're having now, but I've never seen so many of them happening at the same time. So that's what's really unique. And so because of that, I really took a hard look at how I was doing things and made a significant adjustment that I think you're going to find really interesting. So first of all, let me just explain this. This left column here is about being competent physically and mentally to trade. And on my new process, I took that off because that's a given for me now. That's literally posted on my mirror in the bathroom. But if you're just starting building yourself a process, that's important. I find being humble is critical because you know what the worst days I ever have? The worst days I ever have in the market are the day after I have a really good day in the market. And you know why that is? That's because I come in thinking I'm a genius. Yesterday, I made 100 grand yesterday. Well, you know where I'm going with that. And then, of course, the next day is a disaster. So I learned to give myself a humility check. And I also, because of pain management and whatnot, because of my physical condition, I also just knew there were some days I just wasn't competent to trade. Didn't get enough sleep, didn't get enough rest, in pain, whatever. And so that's what that's all about. The second column over, the one titled Context and then Intraday, this one here, that was about, and again, I say was, because I found a way to streamline this that makes much more sense, and that's what we're going to see next. So the first thing was just, what's the context? What's going on? What's the technical picture in the market? Is it trending? Are we having, new highs every day? Whatever. What's the auction structure intraday? That's critical. If the market's an auction, understanding the market structure is the way to see where opportunities are, because traders are telling you by virtue of purchases and sales and bids and asks, they're telling you what they want to do and what they're actually doing. So that's critical. And then order flow is the actual energy of that. So that's what OF is. So I used to go through all these different ways of evaluating that. It's a trend day or not. What's the profile structure? Are there boundary prices, way out at the extremes I like? And anyway, I don't want to go through all this in too much detail. Again, it's just to kind of give you an overview. But then once the day started, which way is the market going? How good a job is it doing? What's the price impact of the delta? I'm talking about the delta at each trading level, at each price. So, are those trades going by on the bid or the ask? That's all I'm talking about there. Order flow always overrides technical analysis. That's what that is. But, that's kind of a given. So after you put something down and you read it hundreds of times, and literally, again, I was using this for close to 3 years. This is an improvement over the one I was using before that. I got to the point where this kind of all became second nature. Ace King, that's my poker analogy. And improvise, adapt, overcome is a critical mentality about how to stay in the right sense of the market, because you have to constantly update your trading process as conditions change. What worked 6 months ago doesn't work now. And so that's kind of a Marine Corps approach to that. You know, if it's not working, improvise, figure out what might work, adapt what you're doing, and overcome the fact that it's not working. And then, you know, I'm a scalper, and scalping is really well paid hourly work. So that, you know, am I being time of day productive? TOD is time of day. So anyway, these are a bunch of setups that I used to do, and I'm not going to go into them here because I'm going to go into them on the next slide. But I kind of plotted them out by the time of day, and this time of day is Pacific United States. So, you know, 3 hours earlier than Eastern, if you want to calculate. And I just do that for my own frame of reference. So 6:30 a.m. is when the regular trading session opens in New York. Anyway, so this was the approach I was taking. This was my playbook. These were the instruments I trade, and I still do. And which setups I was looking for at which times of the day. And so this is when the epiphany occurred. So let me stop here for a second. Yeah, and I will come to questions. I know there's a lot of stuff on this, and you know, that's the point. In 4 Saturdays of an hour or 2 each, I'm not going to go through all of this, but the point is, if you come along for the rest of the ride, you won't need me to, because I netted it out and I made it very simple. This is all still going on in my head, but I figured out a simpler way to get to the conclusion, which is which setup do I want to trade how. Okay, so let's take a couple of questions here, because I see a few that I should answer. Let's see. What is the importance of sigma in the statement sigma order flow? Okay, good question. Sigma is the total in this case, or it means the okay, a sigma is a couple of different things mathematically. It can be used for standard deviations, and it can also be used for sum, and I mean it both ways. And I apologize a bit, I'm a mathematician, so that's the way I think. So it's the collective order flow. And so what I'm saying is, maybe not at one price level, but if I look at the order flow over a couple of price levels, that completely overrides the technical analysis. So if that looks like support, but it's getting sold, it's a short. So that's what I mean. SOH is sit on hands. In other words, if you don't know what's doing, sit it out. And that's a key part of any good process, is to, you know, if it's not clear, don't trade. Your default position should be flat. You should only enter the market when you have an edge, to take money out of the market. The only reason we're in the market is to remove money from the market. We're not there to be right. We're not there to post our P&L in the Top Step group about how smart we are. We're not there to tell everybody that our magic indicator is great and sell it for $5,000. We're there to go extract money. The market is our ATM. So if we don't have an edge, then we should not be in the market. It's that simple. Okay, yeah, I apologize. I use a lot of slang, and we're working on that. I try to translate as I go. So if anything doesn't make sense, please bring it up. Absolutely, Dimitri. But you know what? Dimitri says, I don't want to be right. I want to be profitable. And that's so correct. But you know what, Dimitri? As a human being, your brain is telling you the exact opposite. Your brain is saying, no, it's better to be right. And that's because we have a lot of really primal instincts that, you know, protected us when we ran around the jungle, and we still have that fear and greed. And, you know, if it worked yesterday, it should work today. You know, if the hunting ground that I caught a moose at yesterday, you know, I should go there again tomorrow and there'll be another moose. But moose are territorial. So if there was one there and I killed him, odds are there won't be another one there for a long time. So a really good example, everything that is common sense is not, it's backwards. So you have to really train yourself to think in terms of unconventional wisdom and not conventional wisdom, because it's not wisdom. So good point, good point. All right, any other, again, I don't want to go too deep into the terminology here. I want you to understand that this approach, and we can come back to this at the end if we want to spend more time and answer more questions. But the idea here was the first 2 columns, so these 2 over here, were to understand that I was competent today and focused and process driven, not lizard brain driven, okay? and that I was understanding what I was seeing. You know, what's the market structure? What's going on? You know, what's the news? Are any of my edges available at the moment? And based on the time of day, you know, can I make money with any of my setups? And then this kind of playbook part, you know, with the times and with the instruments up here and these notes and context filters, those were the actual setups. And I had them, again, distributed by time of day. But, you know, laying in my pain bed a couple of weeks ago, I said to myself, you know what, this is wrong. I've been doing this for 3 years and it's profitable, but it's wrong. And number one, you got to teach yourself to question your own assumptions. And the assumption I was making, which is correct, is that certain times of the day, certain setups were more likely to work than others. But I was intrinsically linking the setup to the time of the day, and that was wrong. Because some of them, you know, Open 5A is based on the open 5-minute range. So that, by definition, goes there. But the rest of it didn't make sense that way. So what I did was I thought, you know what? What's a better way to look at it? What's more important? And all right, so look at this notes and context filters. CHOP, correlation, you know, that would be correlation of similar instruments, like all the indexes. Are you seeing any sweeps? You know, if you're trying to scalp a market for 2-3 ticks at a time and you're seeing 8-tick sweeps, you know, that's the market's way of telling you it's not a scalpable market. So, you know, gaps, internals, these are all kind of filters that you can use to evaluate current scenarios. And again, I looked at that and I said, I've got to constantly be going through a flow. And the version before this was actually a flow chart, where, you know, step one, look at this, step two, look at that. And a number of our TRG members are currently working through flowcharts. And I highly recommend that because you're teaching your brain the step-by-step, which is important. But once you become skilled at that, you don't need that anymore. You go right to the solution. You don't need to follow the step-by-step. It's like, you know, once you learn how to play baseball, you know, you don't go up there and think about swinging. You know, you just watch the ball and your body, your muscle memory does it. Well, it's the same thing. So I just, the more I looked at this, the more I thought, you know what, this is just not in the right sequence. So this is what I came up with. This is the new one. And it's really all the same information, but it's organized in a funnel. And like I said, I'm really excited about this. For those of you that knew my other one and are in TRG, I'm really anxious to hear your feedback. But for those of you that have never seen it before, I thought to myself, that's why I decided to do this little workshop and do free for 2 sessions, is I thought, you know what, if you don't have a process, this is a really good place to start. So if you want to create a process, this is what I would do. And your elements might be different, but follow me through the logic here. Okay, number one, we've got to understand context. So we're starting up here at the top. Context is the top of the decision tree. So think of this as a funnel heading down until we get to this set of columns, opportunity, mode, conditions, etc. When we get down there, it becomes a choice. But until that, we are literally looking at a sequence down the funnel, okay? So context, what is that? Okay, again, I'm not a military man, but I love the military approach to process and discipline. So what is SLLS? That is stop, look, listen, smell. That is something that they teach special forces guys in the service all over the world, whatever country. And the reason is because in order to correctly perceive a situation, you have to stop and you have to let your senses work. So that's what I'm talking about there. And obviously smell, you know, is a metaphor. Stop, look, listen, smell. Breathe, take a deep breath, and then collect information. This is critical. What is going on? If you don't have that as a foundation, nothing else matters. And breathing is critical. The guys that know me from my live events trading, I have, and we do that in the group frequently, I have a little pop-up every few minutes that tells me to take a deep breath and breathe. So important. Okay, so to get the context, we have to look at a couple of things. First of all, what's the time of day? TOD is time of day. You know, the market context is very different at midnight when just Globex is trading than it is at noon, an hour before the New York Exchange close, when, you know, everyone's trying to figure out how they're going to take profits for the day. So totally different environments. Therefore, you have to totally look at them differently. But you're ending up at the same point. You know, what setup do I want to trade? So it's a key consideration. Okay, macro. What's the macro? What that means is what's the big picture? You know, if you're looking at indexes, are they correlated? If you're looking at oil, what's going on with Brent? If you're trading WTI, CL, or if you're trading nat gas, you know, these are just, is there something in the intermarket analysis that's important? Because sometimes there is. You know, Iran just attacked Iraq and there's a war in the Middle East. Guess what? That is an enormous macro event that will impact the price of oil. You can bet on it. How it'll impact it, we'll have to find out later, okay? But that will impact it. So what's the geopolitical economic news with a Z cycle? Because a lot of it's BS, you know, Trump tweets, whatever. The point is that those three things collectively are the top of the picture. What time of day is it? What does that mean on a macro level? So if it's midnight, well, they're trading over in Asia and they're gonna open in midnight my time again. I always talk in my time. So if it's midnight here, you know, Asia, they're trading and London's going to open soon. And, you know, and those things are going to impact my understanding of what's going on and therefore my ability to get off a good setup and my edge. So it's critical to start here. Okay, the next thing down is what's the technical picture? Is the market trending? Is it range bound? Is it consolidating? What's the recent ATR, average true range? But I mean that loosely. You don't have to calculate the ATR. It's just, you know, 2 years ago, the market was moving 20, 30 points a day typically, and that's normal for the ES. Now we have, you know, 100, 200, it's crazy. So you have to look at the recent movement because otherwise, you know, any movement today isn't going to make sense. The context of it, you know, it used to be a 4 or 5 point winner in the ES was a great move. My gosh, you know, that in a couple contracts, you can make a nice living. Now it's like, you know, that's the spread. That's your slippage is 3, 4, 10. You know, it's just crazy different conditions. So that's the point. You've got to just assess that. And don't, you know, you can be mechanical, you can be statistical, but you don't have to be. You know, I have a metric that I run, you know, what's the average ATR or the ATR, what is the ATR over the last 30 days, 60 days? But you know, the bottom line is I end up just looking at a chart of the last couple of days and, you know, what were the highs and lows and what was the opening range, the initial balance. Okay, which brings us to the next one, the auction structure. This is all about market profile. If you don't know what the market profile is, you need to learn. Stedelmeyer's work back at the CBOT in the 90s, the great books by Dalton, Markets and Profile, et cetera, et cetera. Market structure, auction structure is literally the clue to what people are doing in the market. You know, all the crap you hear about big boys are doing this and the smart money's doing that, that's all nonsense. If you just look at the auction structure, you can see collectively what everyone is doing. You know, the big boys, that's all crap. There are no big boys. Everybody is just doing their own thing the best they can. And all we can hope to do as, you know, 1 lot, 5 lot, 10 lot, 20 lot traders is just go along for the ride. You know, like those fish that clip onto the side of a shark and just eat the leftovers. That's us. You know, don't delude yourself that you can buy an indicator that, you know, tracks the dark pools. That's the latest nonsense one I'm seeing out there. Or, you know, black box algo, you know, or any of this. It's all crap. The market determines the levels of support and resistance based on the auction structure during the day, and no indicator is going to tell you that. There are tools that will amplify it for you, but they're based on the auction. They're not based on any secret furu, big boy, black box, dark pool. That's all nonsense. So that's context. Time of day, what's the macro situation, intermarket situation? Is there any geopolitical, economic news, Twitter nonsense going on that could impact what's happening in the markets? What's the recent technical picture? What's the recent trading ranges? You know, just look at the range of the day. Auction structure for the day, that's intraday and the previous couple of days, edges and ledges. And then when we've punctured that, how far has it gone? Critical one. Yes, there will be a recording of everything. And I will try to circle back and ask and answer as many questions as I can at the end. And I'll point you to books and whatever you need. Let's just try to get through the main core and then we'll do that. Okay, so we've got our context. What's next? what's going on in the price action. That's critical. And again, if you've been around any of the stuff that I've done or a trading research group, I basically like to look at price action from one of three ways, because there really aren't any other ways that are relevant. Ebb and flow range is when the market is just going back and forth in a range. Very typical midday, some people call that the 8-tick dance in the ES, back before we got real volatile. It would just go back and forth and back. That's just ebb and flow. It's, buying and selling, buying and selling. We don't have a trend. We don't have any conviction one way or the other, and the market's just liquid. And that's nice. And that tells you something. That's tradable. And when it leaves that range, that's also tradable. So this is key stuff. Are we in an ebb and flow range? That's easy. And again, I'll show you charts and live examples of this, in the latter sessions. Right now, I'm just defining them. So literally, if you think of price action just going like my mouse is right now, that's ebb and flow. Okay, price discovery is when we are doing ebb and flow, but we're not doing it in any clean fashion. We're going way up and then way down and way up and way down. And that's what happens right after like FOMC. And the market's just crazy in one way, crazy the other way. And the bids disappear and the asks disappear and the spread widens out. And if you're trading the NQ, it might be 3, 4, 5 ticks from the bid to the ask. And that's price discovery. And guess what? By definition, discovery, people don't know what the market is valued at. Therefore, they're trying to figure it out. That's what that is. Okay? And then high Momo is simply when the market's doing the same thing, but it's only going one way. And that is just a wonderful thing when you get that. When you get high Momo, like we had it in oil a few times, if you can get into the market and get a stop between your entry and the current trade, and the market is really moving, you have the best possible scenario that exists in the market. And that is the thing I like to scalp the most when we get it, is high Momo or H Momo. Okay, so let's pause here. And I'm going to take questions on anything in context or price action. I am not going to answer any questions about the bottoms because we're not there yet, okay? And I will explain what wait mode and scalp mode. I'll explain everything else, but if you have any questions regarding this item, TOD macro, any of these 6 things, please ask them and I will attempt to address it. And Lee, I don't know, excuse me, I know you're monitoring if I missed a question back somewhere that I should be addressing.
No, you're good, Jeff. I think we're up to date
Cool.
dealing with questions through the chat. So anything that you've asked for questions on should appear about now.
Awesome. Okay. Cool. So everybody's on board. We all understand. So basically the top is you're just saying, what the heck's going on? And is what's going on tradable or not? Sometimes it's not. So, a couple of people have heard me say, a lot of times I'll get up in the morning and, for me, the market, 6:30 is the New York Open. So I get up at 2, 3, 4. Sometimes I don't sleep. I trade overnight. And a lot of times I'll watch the Open and I'll say, to hell with this. I'm going to bed. It's just not worth it. And so a lot of it is to just understand what's going on, or you'll catch the Open trade and then, take the rest of the day off. That kind of thing. So it's critical to get context. And then next, it's critical to understand what's going on. If we have ebb and flow within a range, and that might be, the 8-tick dance back and forth, or it could be a larger range, the top of the initial balance or A period to the bottom of B period. That's like another classic range. It's just a bigger, slower one. So you have to understand what's going on. Sometimes ebb and flow in a range could be a 30, 40, 50 point ES range. And you have to understand that that's what you're seeing. Price discovery is hard to miss. If we're doing that, you'll know it. And if we're in HMOMO, you know it. So basically, the one that's hard to figure out is when we're ranging, what's really going on. And that's why that's a really good thing to trade if you understand that that's what's going on. Because what you're doing is you're trading the ebb and the flow. You're not trying to predict where we're going to end up. You're just going with it. Think of it as the tide, or, surfing the markets. I surf, and, you paddle out and, here comes a nice set, you go in, then you go back out and there's no waves for an hour. So you talk to your buddies. Another set comes in, that's ebb and flow. And then every now and then, there's a hurricane in Florida, or in Hawaii, and we have high Momo, man. It surfs up, it's 15 feet, and you just take whatever you can get. So It's important to understand the conditions. It really is. Okay, I want to answer this one. Do you watch for naked pictures, or is that POC that you were asking about? No. Okay, the POC is another useless statistic, and I will tell you why. It's very simple. That point of control is defined as the area of the highest volume, but on any given volume profile, there could be another area of high volume that's only 10 contracts less. So, you know, why is the one that's 10 contracts more important? So the POC is another meaningless number unless you're using some very, very sophisticated statistics within the market profile. But in general, it's not very useful. Okay, it's a place you can lean on if you're using really, really fast you know, footprint charts. You could lean on POCs, but again, it's really important. That's why I said the tabula rasa thing, you know, open mind. There's so much BS out in the world about trading. You know, think about it just for a second. Point of control is literally defined as the volume, the price that had the most volume. And I just explained the problem with it. There could be 5 other areas that had 1 contract less of trading. Why are they not as important? So that's the POC answer. Okay, so going back to, so we've got price action. We understand the context. What's next? Okay, now these are setups over here. If you remember from the previous slide, I used to have them kind of plotted by time. And what I did on this approach is I said, okay, let's just put them all down there. And then what mode do they occur in? Because that's critical. And this is something that I know some of the more experienced traders that are funded or that are in trading research group and working on their processes, this is something people struggle with, is switching from kind of a scalping mentality to a, you know, intraday swing, get in the trade and let it work mentality. And that's a critical thing to learn how to do. Let's see, so I wanted to see if, no, he's not here. Okay, somebody just asked me about that. I wanted to see if he was in the audience because I was going to address it to his question. I'll do it anyway for the recording, but I won't do it for a minute. All right, so the setups are opportunities, and let's talk about them. And I'm just going to go through and define them really fast, again. It's not my intention that you're going to understand the particular setup and why it's an edge or how it's an edge from this session. That's my objective to get you to by the 4th session. This session is just introducing the ideas, and then the next one, which is also free, next Saturday, we're going to go into a lot more detail about the setups themselves, okay? So with that in mind, HMOMO is exactly what it sounds like. It's high momentum. It's going one way. It works only in scalp mode by definition. I mean, it's a scalping situation because you've got a sudden energy. So the price action, PA is price action. So the price action for this setup is always going to be high Momo. I mean, that is the setup. It's really the only thing about that, okay? It happens any time of the day or night. It frequently happens unexpectedly, a news item or a high volume reversal. We'll get to that one in a minute. That's another edge that goes together with that one. So when you see that happen, you want to execute against that setup. You never, ever, ever fade this. If you fade this, and then fade by definition means you go against that momentum. And here's a perfect example of people I see doing this. We'll get high momentum up into quote unquote resistance. That's my Furu voice because the term resistance is nonsense. And what will happen is we'll high momentum up in there and you'll see the little one-lotters come out of the woodwork getting short at resistance. And the momentum will pause for a minute, pull back, suck those guys in, and then it'll just keep on going. And then you see all those guys stop out. And so this trade often has kind of pulses like that, where it'll pulse up HMOMO, and then it'll kind of pause for a minute while it sucks more people in going the wrong way, and then it'll do it again. So this is something you've got to trade really tight. That's what I mean with scalp mode. You know, you don't let it go against you at all. You take profits very quickly. You use market orders to get in because it's daft to try to save a tick with a limit order in something that's going to move fast or is moving fast. And the only trade risk management consideration is that you have a stop between you and your entry, between the market and your entry. And so you can trail that, you can move it manually, you can do it any way you want. The trick is just to keep protecting the profit, because it's going to happen fast and furious, and then it's going to go away just as fast. So you got to just grab it. And this is all of our favorite setups in TRG. When it happens, it's gold. But it doesn't always happen, and the key is looking for it at certain inflection points, because then you kind of see it coming and you can get in, not always ahead of it, but as it's happening is kind of the best. Every now and then, one of the other setups, like HV reversal, which I'll talk about in a second, will kick off an HMOMO setup. So one leads into the other. And so you can often get a little advantage from that and get into a high MOMO event right before it happens. And in the live trading videos that we have up in TRG, there's got to be at least a dozen examples where I was doing that. I was saying, God, this looks like it's going to go based on, this stuff up here, okay? Based on, whoops, where'd my mouse go? Thank you, Zoom, there we go. Based on, the context and based on the price action, it just, you could see it coming, trade's about to happen, to quote the book. And so, I might nibble in with one market order and then try to scale into it if it gets going. So, I'm not discussing trade management here, just a condition for a good edge-related setup. Oh, you are so right, Lambrick. Identifying price action takes a lot of practice, but boy, once you get that right, and a bunch of people here in the group can attest to this, everything else just comes from it. I mean, it just logically flows. I know Amy's saying yes, and Darren, Darren's a funded trader, 150K at Top Step. Amy's been funded at Earn2, I believe. And the point is, these are people that have succeeded with this kind of thinking, and this is a new approach to it. So stay with me here. I think it's a really cool way. So again, once you get this down, which setups you're looking for becomes pretty clear. So what's the next one? Okay, the open 5A. This is the opening 5-minute range. It's a hard one to explain to people that don't understand order flow. So I'm not going to go into a lot of detail here on this one, other than to tell you it's also scalp mode. It has two types of price action. One is high MOMO and the other is in price discovery. Because in the first 5 minutes of the regular trading hours, we often have price discovery. So the trick here is not to take the trade. Sit on your hands if the action isn't one-sided. And learning how to figure out if it's one-sided is the trick to this. This only works at the regular trading hours opening range 5, the first 5 minutes. But I'll tell you what, there are people that make a living just doing this. And we have a couple of traders in the group. This is their only setup. They trade. And if you're going to just do one, this would be the one I would learn, because you could literally trade for, an hour a day, 45 minutes of context before the open, trade the open 5A. It works or it doesn't. You make your money and you're done for the day. So a couple of considerations about this setup. You never fade it. Again, none of these scalp mode setups should be faded, because it's just too easy to end up on the wrong side of the trade, and you're sitting there with, furu nonsense like, well, I've got to give the trade time to work. No, it didn't work. Get out of it. You're wrong. It's the market's way of telling you you're wrong. In my approach, look, there's 3 rules. Good trades work right away. If it doesn't work right away, you're wrong. Get out, start over. Number 2, always take profits. I'd much rather take a tick, pay the commission and end up with $8 than, sit in a trade watching it go against me saying, well, I've got to give it time to work because we're at support. That's just nonsense, okay? So good trades work right away. Always take profits and don't lose money. If the trade goes against you, get out. There's 3 acceptable results: a small loss, a break even, and a winner. A small winner, big winner, doesn't matter. But a large loss is not acceptable. And that's why so many of you, and I know this is going to resonate, you might have success for a month or a week or 6 months, and you're cruising along, you're consistent, and then you have one day and you just wipe out your month. Guess what? You're not trading a process. You're not managing yourself. That's what's wrong there. And if you follow a process, that won't happen. But you have to really drill into yourself that the process makes the rules, not you. Okay, let's see. Was there a question I missed here? Right. Yes, sit on hand watching. Okay. So that's the Open 5A, and it's got a couple of other considerations. High volume nodes, that's what that is. So, you know, you don't fade it. Again, stop entry plus, market orders in because it moves too fast for limit orders. Watch for high volume nodes from the overnight session because those will be inflection points in this trade, and they can sometimes help you get in and understand if you're one-sided trading or not, because that's what you want. If it's one-sided, that's the opportunity. If it's just ebb and flow at the open, you don't want to play that. You want to give it time to play out. Which leads us to our next setup. If the opening 5 minutes is inconclusive, or even if it is conclusive, once it's over, that trade's over. So 6 minutes after the open, that trade's over. And the next thing we're looking for is to understand what the first hour is gonna look like, the initial balance in market profile, the initial balance also called, or A and B period. The idea is traders that are not trading overnight, which is most larger traders simply because of volume, or they're trading lighter overnight, whatever. But once the session opens, you know, the volume goes up, the bigger players put up bigger size, the book fills up, all that stuff happens. And so you've got to give that time to play out. And that's why the first hour high and low, also known as the initial balance in market profile, are critical. So that setup mode is a wait mode because it could get up to it could establish a first hour high and low and then sit at the first hour high for another hour. And what's critical at that point is what's the action, what's the order flow. Again, remember, we start with the technical picture and we work our way down to the order flow because that tells us what the trade is, if there's any trade at all. Okay, so that's that one. The key to this one, obviously it only works in regular trading hours because it is the first hour of regular trading by definition. It is an ebb and flow or a high momentum setup. If we're in price discovery, this setup does not apply. It's that simple. So that's the beauty of filtering with price action. And I just want to see how I'm doing on time. Okay, I'm hitting an hour right here. All right, guys, I'm going to keep going on this and finish the setups. And that should take about another 15 minutes. So that we'll be at an hour and 15. And then I'll open up for questions and we'll see where we're at that point. If I have time for more detail, I will come back and add then. But the setup detail is going to come later in the Saturdays, starting next week and the subsequent times. So I just won't have enough time here to go into a lot of detail. All right, so again, for this third one, the range around the inflection point, in other words, the range around the first hour high and low is what's key. The auction structure and the wave volume, you know, how it's going back and forth. A flip is really a great setup when it occurs. It's when we have an overnight move in low volume, and as soon as we open, it starts to go back the other way. So large counter trend, CT is counter trend, move overnight on low volume. This setup occurs once the regular session starts, and it can occur anytime from that point forward, but it typically resolves in the first hour or hour and a half. It is a wait mode setup, and it doesn't matter what the price action is because you're giving this trade a lot of time to work. You know, you're basically just entering at the overnight high or low, and as long as it keeps leaving there and it leaves that area on more and more aggressive volume, then you know you're on the right side of it and you can scale into it or not. But that trade is a really fun one. The nights I trade overnight, I'm always looking for that in all my instruments. Typically, you get a flip at least once or twice a week across the instruments I trade. So that would be, you know, oil, gold, and the indexes. In one of them, we usually get a flip at least once or twice a week. So that's a fun one. It'd be hard to make a living doing just that because of the fact that it doesn't come along quite as often. Okay, an HV reversal, high volume reversal. You've all seen these before. You know, we're going one way and then all of a sudden we just have, you know, we're going one way, you know, reasonably fast or with some trend or energy. You know, it doesn't matter what the chart is, pick one, 5 minutes, 10 minutes, an hour, whatever. We're going one way. And all of a sudden there's just a huge amount of volume and we turn on a dime and go the other way. That's an HV reversal. It's usually news driven, but not always. Therefore, price action, it's a scalp, and you only want to do an HV reversal when you have momentum. Otherwise, it's not an HV reversal. So that's key. They occur any time of the day or night. Frequently they're based on news, so you see them a lot at night. The volume's low, so they're fun to execute. They typically start as H momentum, and often it's H momentum into the high volume reversal, and then it's H momentum the other way. So you not only can get an H momentum trade, but you can catch a reversal. You just have to really be of the mindset that you have no bias and you're just going with the tape. So that's critical. Yes, no, you're absolutely right. And some of these apply to stocks as well, but I'm speaking particularly about futures. But you see high volume reversals and flips all the time in stocks. A lot of the times that's because of the way that stocks are managed by, you know, market makers and specialists. And, you know, it's real easy to flip, for example, a low liquidity NASDAQ issue, for example, you know, because you just have to be the big guy in the pond and you can push it right over the edge. So anyway, HV reversal, again, HMOMO to HMOMO. Spring upthrust, that's what SPR UPT, that's a spring or an upthrust. Those are Wyckofian patterns, price patterns. They go all the way back to the turn of last century, the 1900s. I love them. I only find them under the current conditions useful in a trending market. So this is huge. If you don't have a trending market, there are no springs and upthrusts. And you can define a trending market any way you want. You know, you could be looking at a 30-second chart or a 30-minute chart. As long as you're only looking at one time frame, this will work. Just don't try to do the multi-time frame thing if you're using springs and upthrusts, because then you're going to find a supportive argument for any case you have. You know, it's the whole point with multiple time frame charts. You can always prove your case, and that's one of the reasons they're not very useful. So spring and upthrust, it is a scalp mode. It happens quickly. You want to get in right when it's happening, or if you can see it coming, do it. Therefore, it's ebb and flow within a range or high Momo. Typically, it's both. So this is one of the ones where it's going to ebb and flow in a range like this, and then all of a sudden, it's going to blast out of that. Again, by definition, that's what a spring is. An upthrust is the opposite, where it's trending down, and it tries to bounce, and then it gets crushed even farther. So that's a really tradable pattern, but you just got to understand, if we're not trending, there's no edge in it, and that's the key. And how do I know that? I tested it over a couple 100,000 trades. That's how I know that. And by the way, everything I say about edges is based on statistics, not for back testing, but for live trades, and there's hundreds of thousands of them. That's how I do research. That's how Lee does research in Trading Research Group. We do not back test. It's meaningless. You know, you can prove a concept idea in a back test, but there's far too many variables, and conditions change over time. So you have to go into current market, you know, and get in there with real money or a really good sim to test an edge. And then you've got to track the statistics, and you've got to be honest with yourself and not, you know, looking for something that proves a point you want to prove. Critical, critical, critical points. All right, the last three are new. And so those of you that saw the last one, remember I told you I've got some new stuff for you. It used to be that edge was, the edge ledge was one setup. But again, this is one of the benefits of teaching. In the process of teaching the workshop last fall for those 60 people, and then, you know, the 100 or so we have in TRG now, I'm constantly getting feedback. And one of the things I learned, and I learned by listening to Lee and his training sessions on market structure, I realized that I could break my edge ledge range trade, and I renamed it. It's an edge range trade now. And I broke that into 3 different types. And again, this was an epiphany for me, because I was always looking at it collectively, and I knew these were different, but I never bothered to split them up. And by splitting them up, I realized that they work completely differently. And Darren, I know you're here. Darren, this is huge for the style you trade, for the stuff you and I have talked about, ranges and gold and overnights. And I don't know if Darren G is here. No, I don't see him. If you listen to the recording, Darren, I don't know if you are or not, but this is the same thing for our gold conversation over on Surfing the Markets and in the Top Step group. So this is just, my mic is being distorted or loud. I was just told somebody, or am I just talking too loud? Is that what it is? I can talk a little quieter. I'm trying to talk over my fans. So is that better if I talk quieter? Oh yeah, that's just my passion. hey, look, you know, I love, there's a Jimmy V video about when, you know, he was talking about that never give up, you know, when he was battling cancer. It's posted in my group and it's posted in Surfing the Market. And, you know, whenever someone says that to me, I say, look, you know, I'm passionate about what I do. I love trading and I love teaching. And if that offends you, and I'm not saying anybody who's made that comment, but if that offends you, go someplace else. I mean, really, and I won't be offended. I really won't. Let me just move my mic away a little bit. Maybe that'll help. I was trying to not have the wind blow into it. All right, so the last three. This is so cool for those of you who did the workshop. I mean, literally, we now have a way to break these up, and it works. I will be doing live examples of this for this group the 3rd week and the 4th week. So number 1, edge range, edge and flow range play. Okay, so the ebb and flow range within an edge range. It's a scalp trade. You have to have ebb and flow within a range, or you don't have that set up. You can do this any time of the day or night. It is much less reliable overnight because ranges tend to get stretched and broken as stuff happens. It doesn't take a lot of energy to move out of a range overnight. It takes a lot more to do it during the day, right? So look for the 8-tick dance, you know, and hat tip to Peter Davies at Jigsaw. That's his term, and I love it. I used to call it just the rookie roast dance, but it's the same thing, you know. And now sometimes it's more than 8 ticks. You know, it's as many as, you know, 4 points, but it's basically just the back and forth, you know. And again, I'll show you live chart examples, but, you know, we'll go up, we'll go down, we'll go up, we'll go down. The volume on the up move will be the same as the down move, blah, blah, blah. You get what I'm talking about. There's some really cool ways to play this in MES now that it got liquid, guys. And I just started posting about this in TRG because it's a brand new setup I'm doing where I'm putting a position on in the ES, and then I am adding to the range of that, scaling in and out using the micros. So I've got a core position on with defined risk in the ES, and then I'm adding to my profitability by scaling in and out with micros, not taking a lot of risk and not getting bored waiting for my ES to play out. And that has turned out to be a phenomenal advantage. You must take profits if you're trading ranges, because the second you don't take profits, it will break out of the range. You'll be on the wrong side and you'll be scaled in. So that's critical. I will come back and answer all the questions. Don't worry. The next edge range setup is called a session ledge. And again, I will show you chart examples. I'll explain this in more detail, but that is a ledge, is the edge of the volume profile. But it's not just the edge of a volume profile, it's the edge of the volume profile for the session. Those are critical because rookie traders always look at them as resistance or support, and order flow traders always blow those levels out by a few points. So those guys get stopped out. And that is one of my favorite trades. Is, you know, when we're up at the high of the day and you can see all the one-lotters shorting it because, you know, it was the high, you know, 3 months ago, and it's, you know, R4, or, you know, and the MACD crossed down, or any of that bullshit, pardon my French. And, you know, all anyone with a brain has to do is, okay, if we just get 2 ticks above that, all those little guys are going to stop out and they're going to run for cover with market orders, and we're going to take profits into that event. So that's my absolute favorite trade, because I just watched the rookies getting roasted in that one. It's clearly a scalp. It works in both directions. So it's key to understand that. It's a long, let's say you're at the top, it's a long, and then it's a short. If you're at the bottom, it's a long and then it's a short, or it's a short, then it's a long. So it reverses typically. It is not a breakout setup. It is a scalping setup. It works really nice at the extremes overnight. And that's a key difference between this one. If you're at a session ledge, which is an extreme, you know, the low of the night or whatever on lots of volume, you know, like when oil was $5 last week, and then we bounced to 20 or to 15 later in that same session. That was a classic example. It just got overextended. And so those occur either in ebb and flow or in high momentum. Typically, it's ebb and flow that breaks out into high momentum as it does that little breakout. So it typically you see both of those types of price action. So we'll be right up at the high, and it will let, let's say this is the high here. It'll do like this up there, and then it'll pull back a little bit, suck those guys in, then it'll blow out to the upside. So that's what I'm talking about. And again, I'm going to show you guys all real examples of these. So, if it's not making total sense now, it will. Okay. And then edge to ledge. If you were in Lee's session about market structure and about the A to B opportunities using the TPOs, the periods, if you're familiar with market profile again, that's a really good trade, but you need the right conditions for it. You want to understand that trade can take some time to work out. If you're at the first hour high and order flow is crappy and you see it getting sold, and it was sold up there overnight on the 30-minute footprint chart, same thing, then you say to yourself, okay, within a couple of ticks here, I've got a good short opportunity. But it might take, most of the regular trading session for that to work out. So that's what wait mode is. You got to get into it and give it a little room. You might have to take some heat. So again, that takes a little bit better management than some of the scalp trades do. It can occur with any price action. And typically that trade, you'll see all three of them at some point during the trade. Although price discovery would scare me if I saw a lot of that. So I would probably bail out if it got too discovery. And why? Because I can't predict it. It's just too unpredictable. So it's mode, obviously it's weight, any price action. This is a trade you take during regular trading hours, again, by definition, because you're trading the session edges. So, there aren't any overnight, okay? The auction structure is the absolute key to it. Nothing else really matters. One important considerations, and I use the word key too many times, I need to change that. A consideration that's important is the ATR. In other words, when it breaks the first hour high and low, how far away is it getting? What's the excursion been over the last few days? Because that'll give you an idea how much heat you should plan on taking if you're doing this trade. Okay, so having done all that, we have covered the basics of this. And with that, I'm going to stop and hit the questions, and we'll see where that ends up. So let me see, scan back a bit to the, okay, H3 reversal. And point me, if you need to, Lee, point me to any questions I might have.
Yeah, Jeff, I've made notes of some of those that have come up that haven't been addressed. So there's a question from Scott earlier on. Do you make any use of the COT, commitments trade reports? I know the answer, but I'm going to let you answer it.
Yeah, no, I don't at all, for a couple of reasons. Number one, they're very, very, very macro. And, look, trust me, if there was any edge in those, it would be very easy to make mechanically, because, the commitment trade is a statistic and it's based on the past, and we don't always know what those people mean by those positions. They could be hedges, they could be speculative positions. All of the data is confusing. So the long answer and the short answer is no, and that's the long answer as to why not. Next question.
James asked whether the grind up in ES yesterday around lunchtime was an example of HMOMO. Now, the clue there is in the question.
Yes, it is exactly. Okay, and again, I'm going to assume I understand your question terms. By definition, for me, a grind would imply kind of very slow back and fill, but not going down. And that's a classic form of ebb and flow. You've got an ebb and flow that's getting bought. And so if that's what you mean by grind, then all you would get out of that, there's no HMOMO there. You've got a trending market that you want to buy on the, let's use ebb and flow. Ebb is going up. In this example, flow is coming back. If it's grinding up, you want to buy the dips, but you better make sure you're reading that right. So, and it's important to understand your tools. I watch that on the dome, and then I use footprints for context. And I use some wave volume on a 5-minute chart for context. And that makes it really clear to me. You'll hear me say a lot of times when I'm just posting on surfing or in TRG, and I'll say, we don't call price levels, but I'll say, there's a bid under the market. So that would be how I would define a grind. And those are really hard to trade, because where do you enter? If you don't enter right, you can get caught in one of the, the ebbs or the flows and get stopped out. And so it's really important to really read the order flow to get those right. So go ahead.
So, and just to that point, for the benefit of James, who isn't a member of TRG, we don't call levels, but yesterday was almost a textbook example of one of the setups that we went through in our market structure-based setup workshop a few weeks ago, and it got posted there when it had the potential to play out, and indeed it did play out. So, we don't call levels, but we'll highlight case study events either just afterwards or actually in progress, because it helps build that knowledge.
Exactly. I want to hear the rest of the questions, but I want to address this one right now that Noel's asking. HMOMO is when pullbacks are getting bought each time. Not necessarily. That could be ebb and flow in a range, and then it's breaking out of the range after it consolidates in that range. The key HMOMO is when the energy changes. So don't think about the market profile for a minute, Noel. Think about the energy of the tape. Like when the tape speeds up and all of a sudden you start seeing blocks on one side or the other. Boom, it's overwhelmingly one-sided, exactly. That's HMOMO. And often HMOMO is how we break out of an ebb and flow range. So you might have, if you're looking at a 30-minute chart, you might see what just basically looks like a trend day. But what's key is what's going on under the covers, because that's how you get good entries into those trades. And that's why you have to drill down to a much faster time frame. And again, that's another good point. The Furu world always tells you, if you want to understand your trade, you have to go out. Look at the 2 hour, the 2 week, the 2 day, the 2 year. That's nonsense. The best information is in the short term. The order flow of a 15-second chart or a 30-second chart or the dome, that's telling you where the price is going to go. If you're looking at a 5-minute chart even, or a 1-minute chart under high Momo conditions, by the time a candle prints, it's too late. The trade's over. Critical point to understand that.
Noel also asked a little bit earlier, just scrolling up to find it. Yeah, hang on, I've scrolled too far. He was saying edge flow as in balancing low and high, as in Globex low, or high. And I think here it might be a bit of a misunderstanding of the EF for ebb and flow abbreviation, but also what I'm sensing here is, Noel, up front we said tabula rasa, blank slate.
Right.
And you're throwing in, a few market profile concepts here, balancing low and high, balance, all this kind of thing. And the key to what we do in Trading Research Group is throw out the old concepts that you are using at the moment and don't try to stick the stuff that you're hearing into the buckets that you already know. Otherwise, you won't absorb it.
Absolutely.
So, edge flow, we refer, I think it was a nomenclature issue. So, it is ebb and flow is the price action style. There was also a question from Daniel about news feeds, and given that high momentum can be triggered by news, Jeff, do you actually keep a news feed open while you're trading?
Oh, there's a good one. If I was asking for a straight person to ask good questions, you guys are asking them. I'm literally, if I paid you to ask questions. Here's the answer to that one. It's really simple. By the time something shows up in a news feed, whether it's paid or free or Twitter, it's priced in. So if you're using a news feed, you're not smart enough, nor am I, nor is any human being, to understand the ramifications of anything and understand how you might trade it. You're fooling yourself. And I would be fooling myself if I said I could do that. Not possible. And anybody tells you it's possible, and anybody selling you, a real-time news feed, the way you handle news as a trader is if the market gets into high Momo or price discovery, you deal with that. And then you go back and you say, oh, what happened? Why did that happen? Afterward. Because we don't care while it's happening what started it. It's irrelevant. All that matters is it. And so, for example, if you're in a setup that you're not expecting price discovery, and all of a sudden we get price discovery, hit flat as fast as you can. Why doesn't matter. The edge that you entered the trade for no longer exists. So that's it. End of conversation. So I hope that answers your question.
Yeah,
okay.
And there's a great question from James. Do you use tick charts instead of 5-second charts?
Yes, I love this one too. I saw that one coming up. Okay, I opened my trading platform while we were talking just so I could show a couple of examples. No, I wouldn't use a tick chart ever for a simple reason that a tick chart is consolidating action. And I don't want to see it consolidated, James. I want to see what's actually going on. So for example, here's a 30-second chart. And I'm just going to show a few examples of these things because we have a few minutes to do it. Okay, so here's a 30-second chart, and let me get a little more data here. Oh, you know what? I'm not connected yet, and I don't know if my data providers are going to be working today. Let's see. Hang on one second. Oh, let's try to get some data. This one should be working. Some guys do maintenance on Saturdays, and whoops. Okay. Hang on. The Zoom toolbar disappears with multiple monitors, which for presenters is really annoying. So hang on. Okay, we're getting data. And then I'm going to give some really good examples of some of these for you. So why don't you go ahead and throw up some more questions for me, Lee, and then I'll come back and I'll show some examples of those.
Actually, I think that's pretty much it. There's a question from Bill about the Chart to Dome workshop. I'm dealing with him privately as part of his TRG membership. Zhang has asked a couple of questions. One was, how do I get printed copies of these materials? Well, Zhang, there will be a recording of this, which we'll post on the Trading Research Group Vimeo channel some point in the next 24 to 48 hours. But also, if you join Trading Research Group, which Jeff will explain that towards the end of this session, then you've got access to every recording of every meeting we've ever done, which is, well, it's about 100+ hours now.
It's 400 hours, not 100. Yeah, you've been quoting this wrong. We have almost 100 videos. The total number of hours is close to 400. Lee.
That would mean they're 4 hours each, Jeff. Okay,
then the count might be low.
Yeah.
Whatever. Hang on, let's go look.
Indeed.
Yeah, you know what? So here's the library, guys.
Yeah, Zhang. So you get access to our library of all recordings of every meeting. It's it's big. 2-3 meetings happen every week. We've got a 24/7 Slack discussion group that's pretty active.
Yeah, I'm going to bring that up in a second too. Here.
Yeah. So the way you get these materials is to join Trading Research Group and join this community.
Okay, so here, let me just show you around real quick. So this is the library on our website. And so the Ides of Monday, we do a session every Monday that's a conversation. And so they're all under there. So like if you look at March, you'll see, all the ones we did in March are there. And so I think there's more than 100 videos now, Lee. I think we're probably at 130. So the setup workshop alone is 30. That's the fall that we did. That was 3 months, and all the videos are there. And all kinds. That's where we talk about developing a process, and how I got to the one I showed at the beginning of the session. And then Lee's trade setups based on market structure, that we talked about that a little bit, and the different sessions from that. And there's just so much good information here. We have a bunch of live tape reading. Anywhere you see the word live or Doc tape reading, I'm Doc. And so those are sessions where we did that. We go into the Delta Deep Dive was another great session Lee did, unfinished business. So these are all, multi recording sessions. And if you go in there, you'll see, that was that one, 1 hour and 20 minutes on microstructure and unfinished business. So there's all kinds of good material there. And then we also have our Slack, which is this, and all kinds of conversation going on there on many topics. We are a great group of like-minded individuals. You've been talking to some of them in the chat. Amy's one, Darren's one, David's one. And the setups that I'm talking about are posted here. See the word setups, and then JM is me. So these are all of mine, and I'm going to populate that with the new material. The slide deck will be in slide decks. The video will be posted on the homepage. If you're not a member, you'll get a link with a recording, and the slide deck we'll get a link for that. So if you're interested in any of this stuff, here's the mechanics of it. This session is this one on the 25th. That's today. Next week, same time. You have to register separately. I will post a link in Surfing, and we will send a link to all of you. Lee, we've got to remember to do that when this link goes out, the link for the next session.
Yep, absolutely.
And that one is also free for those of you that are not members of Trading Research Group. And the reason I did that this time instead of just the teaser and make you join is I wanted some more time to go into the setups, because I know some of you really want to understand what we're talking about here. So next week we're going to spend more time on that and the idea of edges. And that one will be free as well. And then after that, you got to join our group if you want the rest. And that's how you do it. There's the link. And once you get there, you'll have access to the library. And you could literally just watch the library for the next month and not use up all the videos. So we also have these roundtables that are really interesting. We had one yesterday on doing combines and other people's money. And a bunch of people that are funded traders at Top Step and at Earn to Trade and One Up Trader were sharing their experience, and we discussed strategies on how to pass a combine. And this was a really great session. I really enjoyed it. And not the least of which because I didn't do all the talking. We had some other people contributing. So anyway, that is what we're all about. That's the big pitch. And now I'm going to go back and I will take any other questions until we run out of questions.
So Zhang also had a question relating to exactly what's on the screen now, Jeff. It was about the terminology. Basically, it was what is PA, what is EF. So the abbreviations in that PA column, price action,
yes, okay,
ebb and flow, etc.
Yeah, so that's price action. Yeah, and I use a lot of abbreviations. And Amy, as we speak, is putting together a glossary. There's some new ones for you there, Amy. And we're getting that posted in the group. It's just we've been kind of creating it along the way so that we're all speaking the same language. And basically, these are the setups. I renamed it opportunity because I don't like the word setup. It's overused. It's an opportunity, but you still got to execute it right. And you still got to make sure you're seeing the right price action and you're trading with the right mode, or it's not going to work. So the opportunity or the setup is contingent on the price action, and it's contingent on a mode of mentality that you have to execute that particular approach. The pink ones are scalps. The blue ones are, it might not work instantly. So you've got to understand where your exit is, what's the risk, and then you got to take a step back and let the order flow guide you. And it might take a little time in that, in the blue setups. So the price action is the conditions under which price actions, these are valid setups. And what I did, I should have put it in parentheses here. I abbreviated these. So HM is high Momo. HMPD is high Momo or price discovery, and slash means or in this case, the mathematical or. So ebb and flow or high Momo. High Momo or price discovery. Any, it doesn't matter. High Momo only. Ebb and flow, high Momo. Ebb and flow. This one is different. This is a very unique situation. You should be looking for ebb and flow that leads into a high Momo break of the ledge. So that one is a unique combination of price actions. And let's see, ON is overnight, sit on hands, high volume node, inflection point, counter trend, micro ES, order flow, first hour high and low, average true range, regular trading hours. Edge is the edge of a volume profile. Ledge is a volume profile edge that is the edge of the session, because you can have multiple profiles within a session, but only one of them or two of them is the ledge. Here's a good example. Edge, edge that's a ledge. Edge, 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 edge that's a ledge. Okay, so that's just one simple example. Here's also some examples of price action. This is what ebb and flow looks like. This is what ebb and flow looks like, okay? Let's see if we can find an HMOMO. There's one, can't miss it. Okay, so what is this? But notice how on a 1 minute chart, it's over. You can't even see it. So that's exactly why I said what I did about the information will come to you on fast time frames. If you insist on using charts, and we have a whole extra little workshop on this, the chart to dome, then you need to understand what charts to use. Hold on once. Why aren't I going back there? Oh,
this
I need
is
more time
timely,
here.
Jeff, because the penny
Yeah.
has dropped for James. So you can now see why you use second charts, because you can see what type of price action you have. And Joe has actually asked, can you please finish the answer to not using tick charts and this idea of
I'm doing it right now.
aggregation and all charts are wrong.
Yep. That's exactly right. All right, let's get the data here. And you know what? Let's hop out to 20 seconds. It'll be a little easier to get all this data here. Give me a second.
And tell you what, Jeff, while that's loading up, so I know I'll take a moment in Ninja, Bill has asked whether you worked the Open 5A during the Eurex or London Open, either in DAX Bund or US, this is going to be hard to say, US
I got it. I understand.
Instruments.
Yes, great question. And the Open 5, let's just let this populate for a second. The Open 5 setup is valid in any market that has overnight and regular trading hours. So I get asked this a lot, and before this session this morning, I thought about that for a while, and I said, okay, this is how we're gonna answer that. And so it could be any major market, and the reason is because think about it. And again, I'm going to go into this in a lot more detail in future sessions, but basically what's going on right when the market opens is the liquidity expands dramatically. The volume picks up, so anybody that wants to trade is going to display their intentions by buying or selling. So if there's an overwhelming amount of buying or selling that's going to happen, it's going to happen right away, and it's going to move the price right away. So no. The Open 5A is the first 5 minutes of regular trading hours, JK. So that is, for example, in New York, if you're trading the New York Stock Exchange hours for the futures of ES, it would be from 9:30 Eastern to 9:35 Eastern. If you're trading in the London market, you're trading the DAX, you're trading in Shanghai, whatever the first 5 minutes of regular trading hours are, that's what it is. Okay? All right, so I was able to bring up, this isn't going to cooperate because I've realized that's my 5-minute chart, and it's bringing up all the wrong information. So sorry, my coffee's wearing off. I'm going to go grab one of these, and I'll be able to show you some examples of price action real quick. Okay, so here's a 45-second chart of YM, which is the Dow futures. Okay. Ebb and flow, ebb and flow, ebb and flow. We leave ebb and flow, but we're not doing it on high momentum. We're just seeing dips getting bought. So that's just a nice little trending move out of ebb and flow. So, you might want to get long there as we left, or you might wait for another opportunity. You have a couple of springs here. You can see them. We have pullbacks on low volume and moves up on much higher volume. So we spring up. That's the definition of a spring. So if you're trading a 45-second chart, you could be buying these little pullbacks. And that is a perfect spring up thrust setup. So that is this one right here. Okay, now let's look at what else is going on this chart. We got up here and then we just pooped. I mean, the selling just overwhelmed the little range we were in. So that is a high momentum breakout of an ebb and flow range. And notice how it ended just as fast as it started. And that is a high volume reversal. So high ebb and flow, ebb and flow, ebb and flow. HMOMO breakout of ebb and flow back to an old ebb and flow range. Don't call that support, but that's what you would think if you're using that term. Okay, the guys that got short here and made a bunch of money took profits. We bounced back up. And in here, there's not a lot you could do. You could maybe catch the high volume reversal here if you were being nimble and, take profits right away. So those are just a couple of examples of those setups. They occur on every instrument at any time of the day or night. Obviously, oil's had a lot of fun lately, so let's look at oil. And okay, this is the one I was talking about. That is a HMOMO event into a high volume reversal with another HMOMO event. And look where it ended up. Ebb and flow, ebb and flow, ebb and flow. HMOMO breakout, join that puppy. When it ends, turn around and go the other way. Right back up, back to ebb and flow, like it never happened. These are enormous opportunities. But guess what? This is a 45-second chart. We can't even see it. If we drill down to 15 seconds, we will see the setup perfectly. So once again, if you want to learn to trade, dump the notion of zooming out and long-term charts give you better information. The exact opposite is true. Ebb and flow, ebb and flow, ebb and flow. And then look what happens. You know, there was a little bit of selling. It tried to bounce and it got crushed. So the second that selling started, you could just market order in. And even if you had slippage, hell, in this market in oil, what was that, 1684? You could have slipped 20 ticks and still caught a beautifully profitable trade. And then it might have taken a couple of beats to realize we were reversing. So let's say you didn't get back out till here. And let's say you didn't get long till here. You know, it's 50. You still have up to 50 ticks, okay? I think I'm making my point. You know, the opportunities are on the fast time frames. They're not on the really long time frames. So dismiss that thinking. Again, tabula rasa. Just, you know, assume you don't know anything and just try to, you know, for the benefit of the doubt, say, you know what if he's right? I'm just going to take a look at this. What if what he's saying is true? Then, God, could that be a game changer for me? I don't know. Could it? Ask some of the people that are trying it. All right. Are there any other questions? Oh, I want to show you the bond profile one. I started doing that and I never finished. So this is the answer to the ledge edge one. So I'm repeating and clarifying. Okay, here we have the volume profile for the regular session for ES yesterday. Okay, so that's the session high, that's the session low. This is the opening range or the first hour high and low. How do we know that? Well, you can see it if you look to, you know, my session starts at 6:30, so let's just find 7:30. All right, that's the first hour low, was put in early. Okay, we tested it briefly, it got bought. Guess what? What's that? Anybody? That is this setup right here. That is the open 5B transition to the first hour. It's perfect setup, but that doesn't mean you'll automatically make money. You got to execute right. So you would see that behavior down there. You would see the delta is strongly on the buy side. The cumulative delta is trending up. You have absolutely no risk in buying that, but not because it looks like support, because it's getting bought. It's an inflection point. It doesn't matter that that's 85. I don't care what the price is. One of the things I tell people that are learning this is, you know what, take the prices off your chart. Just watch the action. It doesn't matter what price that's at. It matters what's happening there. Let me repeat that. It doesn't matter what price that is. It matters what's going on there, or what went on here, or what's going on there. This is a little baby ebb and flow that springs up. Another spring, another spring, another spring. And so this is the edge and the ledge. It's the session edge. But this is also a pronounced volume profile. This is what's called a double distribution because there's two large volume areas. And this one has its own edges right here. And this one has its own edges here. This area right here is no man's land. You don't want to be in that low volume node, also known as the middle. It's just, you know, the price will move through that very quickly because not a lot of traders were interested. They were interested here, they were interested here. And look what happened up there. You know, you can see we got to the top. They stopped out a few guys that sold the high, and then the sellers came in and took profits. So once you kind of get the hang of how to read this, it becomes pretty easy to see. I'm not saying it's easy to trade and make money. It just gets easy to understand what you're seeing, or easier, I should say.
To that
right.
point, Jeff,
yes.
there's a question from Greg, which I think, you know, we should speak to in terms of trading style. And he's saying, you know, win rate is important relative to the average win size and the average losing size. What's the expectancy? So I think there's a couple of misconceptions there that need to be addressed. Yeah,
that has some of the statistical. Greg, you're asking a question that's, and I'm just going to frame it based on the way you're asking it, that's framed with a lot of things that you hear in Foo land, you know, that in order to enter a trade, you must have this risk reward, and you must have an average win that's bigger than your average loser, and you must have an expectancy rate of the following. You know what? Those are statistics based on the past. Nothing matters but price and taking the opportunity that the market gives you out. So some trade setups, I'm looking for a tick. I don't have expectancy, and I don't use numbers like that. I just look at the results. My results, if you want to know, as of right this very minute, and I post them every now and then in the group, about 89% winners. I'm a scalper, so you know you need a high win rate, and I will not let in any real account you know, unless I'm doing something, an example of what not to do, which sometimes I do demonstrate, I just won't let a loser go against me. You know, what does that mean? It depends on the setup. I'm willing to give it a lot more room in, you know, an edge-to-edge range trade than I am in HMOMO or the Open 5A, where I'm willing to give it none whatsoever. So I have no expectancy. An HMOMO trade might give me a tick or 2 or 3, or it might give me, you know, 100 ticks. So that's just a really dangerous way to think. It's the way that you should go back, Greg, and evaluate your results. It is not the way that you should create a playbook. Critical, critical point. I hope I explained that well. Thank you, Amy. I see your private comment.
Yeah, and there's one question from James asking, what does price discovery look like? But I think there it's a question of have some patience, because this is a 4-part workshop.
Yeah, it is, and you know, I'll show you an example or two of price discovery. Hang on, because when you have price discovery, it's just wicked obvious. The best place to see it is on the dome, and if you look in the workshop, in the videos in the library, any of the videos that have the word live or tape read or doc tape read, I do that, and we will see at least once in any of those what price discovery looks like right at the open. But I've got another chart I can show it to you on. And again, you know, charts are useful for the purposes of seeing context, but otherwise, you're not going to learn anything looking at charts. But I can give you good examples of some of them. Hang on, oh, I'm sorry, I heard something in the background. It is a spam call, so let's send him off into higher purgatory. Okay, I'm sorry, hang on one second. My phone is not letting me mute itself. Okay, all right, so this is a 15-minute chart, which is way, way, way too slow to see. It's showing ranges, but there's some really good examples of where you can see those events and see how the volume just totally telegraphs to you what's going on. And thank you, Brent, for explaining my Bubba, my Bubba terminology. Okay, so here's a really good example, and I'm just wait for the delta to populate here so I can talk to it. And we need that Jeopardy music. So these blue lines are the first hour or the initial balance or the opening range 60-minute highs and lows. And these greens are just the previous day highs and lows. You can see like that one's up there because that was the previous high. And so here's a really good example of this was the overnight. And there's ebb and flow. And again, good example of ebb and flow because, you know, we go up on 14K, we come down on 30K. We go up on 12K, we come back on 16K. You know, we're just kind of meandering around in a what? You know, this is the new times in a 16-point range. You know, that in the past would have been a whole day, okay? Then we have an open, and you can see the open 5 here. This is a 5-minute chart. So the open 5 was get long and get the heck out of the way. But on a 5-minute bar, by the time you saw that, it would have been over. And even a 1-minute chart will not show you that fast enough. You will be a day late and $1 short to that trade. And again, give it a second to populate, and I'll show it to you. So, all right, so that's it right there. And again, let's wait for the deltas, and let's stretch that out a bit. And then I can give you some more detail on that. So basically, if you assimilate the price movement, remember the process is doing, okay? The process is saying, okay, you need to start with the technical picture and what time of day is it and what's the auction structure? Well, that's this right here, okay? So, and again, let me just get this 1 minute. It's taking its time loading data here. Saturday rhythmic data feed. There we go. Okay, so all right, now the day we're looking at was this one. Okay, so this is a 1-minute chart. Even on a 1-minute chart, you completely missed the trade of the day, which was getting long right at the open. But if you look at that same event on the dome or on a 15-second chart, every bar is above the other, and that's the setup. If you have overwhelming price action in one direction, get the heck in with a market order and hold on for the ride. And so what it did was, you could see it blew right out of the The opening, it pulled back a little bit. We called that the head fake, and then it just took off. This was a ledge right here. It blew right through it. So that's another setup that occurred at the same time, which was this one. It was a session ledge breakout, and it happened right there, okay? That was the high, previous day, high of the overnight. It blasted through it, and look at the delta. The volume just picked up and screamed. Then we had a pullback, then it did it again. We established the first hour, and then we danced around at the first hour for a while, and then something happened. Again, by the time you get it on a news feed or whatever, it's too late. And we had HMOMO down into a high volume reversal, yada, yada, yada. Okay, so it's real easy to take any given situation and understand what you're seeing once you learn what you're looking for. Ebb and flow, ebb and flow, ebb and flow. It's the easiest one to spot. And it's the one where, you know, if you understand it, you know, and you sell one side of the range and buy the other, and you're reading it well, you can really make a lot of money just, you know, just with ebb and flow. But it's a learned skill. And that's why I was addressing that to a couple of the TRG members, Darren and a few of the others, you know, that are trying to learn that one, because that one's a gold mine if you can get it right, but it takes a lot of practice. All right.
To that point, Jeff,
yes.
Bill has asked if you can briefly touch on reading the range volumes, the zigzags, and what do you look for? So in the context of, you know, showing ebb and flow price action, that's a good question, I think.
Yeah, it's a great question, but we got to go faster to make sense of it. So let me go to 30 seconds and we'll give it time to come in. The last move, the delta and volume was red negative, so why take so long? I don't understand the question, JK. The opening trade I talked about, why take so long?
So why take a long trade? I think
why take a long? Because the only thing I care about is the price. The delta is irrelevant when the market's going up. That's why you take a long. I mean, let's go back and look at that again.
No, and in our delta clinics, we explain, you know, the reaction of so many people get trapped on thinking, you know, delta has to be supportive of the price action, whereas actually the other side, it just tells you who's winning.
Yeah, and this was a case where they faked it out enough, and you see this a lot at the opening 5, where there will be a head fake move, and I've described this in a number of the videos, and it's often just a couple of larger players looking to see, and listen really carefully, there's no big boys, there's no, you know, smart money, all right, that's all nonsense, that's all bullshit. What's happening is there's guys that want to trade, and they've got a big book, they've got 1,000 contracts, and they're waiting to see what the other guys are doing. And we see a weak move down, and they come in like gangbusters. And because they do, it's self-fulfilling. And just look at the momentum out of here. I mean, we pulled back on 4K and we launched up on 50K. So on 30-second bars, the volume is 10-to-1 on the buy side. So I don't care what the delta is. All that matters is which direction are we going and how aggressively. And you can see the same thing happening here. So what the volume swings tell you, and that's Wyckofffian, the idea of looking at volume swings is the Wyckofffian part of what I do. Okay, so there's a market profile component, there's a price action component, and then there's a Wyckoff component. And Wyckoff, his genius was in seeing this ebb and flow and understanding that it looks different when we leave there. And, you know, so if you just take this entire area here, so, you know, once we cleared the first hour high again, we literally didn't do anything. And that's the rookie roast. That's the middle of the day. That's why you don't want to trade that time of day. Stay out of the middle. You know, there might've been some good high Momo opportunities or scalping, but in general, not a great time to trade. And then look what happens. The personality of the tape just changed, and it happened in an instant. There's no warning. There's no indicator. You know, there's no, you know, thing you're going to see on a chart that's going to tell you that you should get short there. If anything, this price action's telling you you should be long because you're above the first hour and you're holding there. And the moves up, the volume on the moves up is bigger than the volumes on the move down. So right up until this moment, that was a decent long setup at the first hour high. And that's why you have to understand technical analysis is useless, because it was a technical long until the very moment that order flow said it wasn't anymore. And then we went from 28.25 to 27.85. Do the math there, guys. That's almost 50 handles. And it happened in what, 5 30-second bars. on massive volume, 70,000 contracts traded, and we had been trading 3 and 4 on the ebb and flows. So that should be a really good example of ebb and flow, of a high Momo break, of a high volume reversal. They all were there, and you can see the volume profile behind it. That was an edge ledge setup as well. So, in the back of your mind, if you were watching that, you would say, God, that's a long if it breaks out. But boy, if any selling comes in, I want to go the other way. Remember, session ledges are always two-way opportunities if you watch the order flow and you get this, support, resistance, technical analysis nonsense out of your head. Then you'll get it right. You'll call it right every time. But if you're thinking, oh, we're at resistance and, it's a short. No, you're wrong. It's not a short until it is one. There's no such thing as resistance. So stop doing that and start learning to follow the price action, and you'll just be infinitely better off. So again,
sorry, Jeff, a couple of people have commented, that fall was the Gilead news release. Well, it wasn't. That was the market's reaction to a leaked report. But by the time you found out what caused it, 5 minutes had passed.
Yeah. So
the order flow told you what was happening, which was stuff was being sold aggressively.
And it told you the minute it happened. I mean, So for those of you who are saying, well, I use a news feed, you're full of it. Here's how that would go down. Okay, you saw, suddenly there's a ton of sellers. So you take your eyes off the chart or the dome and you go look at your news feed. And, even with the best news feed in the world, it might take a beat to get there. And you say, oh, okay, Jilly. So now you have to think about that for a second. Smartest person on the planet, you can automatically figure out what that means in 5 seconds. Well, remember, this trade went down in 5 30-second bars. So you missed it. It's over. Doesn't matter why it happened. It's over.
Christine has questions about the Open 5A. Saying, so you enter at the open in the prevailing market direction if all other conditions are met. Now, obviously, Open 5A is something we're going to get into more detail later in this series. Right. But I'd say she's kind of got the premise of it spot on.
Yeah, exactly. So here it is on a 5-minute chart. And my charts plot the opening 5 in this pink line. And then when it gets to the hour, it plots the blue line. So this right here was the open 5A. And look at the action in there. On a 5 minute, it's really hard to see it. But you can see the result of it, Christine. And the result of it is it got sold. And it was a great short until the first hour formed. But the giveaway is not on a 5-minute chart, and even on a 1-minute chart. Let's go down and look at it. That's why you really need to drill into a faster time frame or to watch the dome and actually see the order flow. So yes, you got that absolutely correct. And I'll let this populate and I can show you what that looked like on a 1 minute, which again is still too slow, which, when I tell people that, they're like, that's crazy, but no, it's not. It's exactly right. So here, look. So this is a 1 minute chart. So we opened right there. Okay, that's 6:30. And you can see that just the 1 minute has a reversal on it. You see it? It's a blue candle there, and it reversed all by itself. Here, I'm trying to spread it out so we can see it. It's hard to do here with this price action. So let's go in a little further. Johnny, tell them what they've won. Let's go for 30 seconds. And again, now, if I drill in, and it's going to be hard to do, but now I'm looking at 30 seconds and I can see that was the very first 30-second it got sold. And so even if I didn't catch the top of the open 5, I could see that the overwhelming direction was it getting sold, and then it ends. And so at this point, I should be short or thinking that, and then it just keeps going. So, even if I wasn't there, I certainly could join there. And that's a great opportunity. It's 96, and we got all the way down to 84. So yes, you are absolutely correct. That is how you interpret it. Okay, what other questions do we have, Lee?
JK, and I wish he'd registered with his real name.
Yes, I did
the initials are familiar, but he was asking about
the opening. Did you write the books about the kids in Hogwarts? Isn't that JK?
I think that's it, yeah. He's wondering about that opening trade where, it was long and suggesting wouldn't the pullback have been better. But again, I think, we're getting into the purpose of today's session is not to give you step-by-step, blow-by-blow procedural ways to trade this stuff. Here are some examples, and there isn't an instruction manual.
Yeah, and he just asked another question. JK, you're asking all the Furu questions. No, we don't have, okay, Justin, thank you. We don't have a trading room because that's nonsense. Showing you in a trading room what prices I'm buying or selling is crap. What I have to show you is how to find the places to buy and sell. So that's what we do live, and that's what we teach. We don't show people what we're doing because that's what Furus do to charge you memberships. Our membership is about education. And yes, I do it live right in front of you sometimes, but I don't want to do that every day. There's no trading room because nobody learns anything in a trading room. They watch someone else do something, and the way that you learn something is by learning a methodology and then by practicing. And there's a lot of people here that will back that. And again, I'm not being critical of you. You just, yeah, Furu is fake guru. That's all the people on Twitter, you know, telling you that, you know, come to my room, I call it out, and here's my P&L and all that nonsense. The right approach is to learn how to do this. And you don't do that by watching someone else do it. You do it by understanding the approach that someone else is taking and not buying their magic indicators or anything else, but learning how to see what they're seeing. And the way that we teach that is first we teach theory. And then if you look at the library, we have countless meetings where we go over it live, we watch the tape, I explain what I'm seeing, or we go back and we look at structural analysis like Lee does and says, okay, when we do get up to, you know, this level up here, what is the right thing to be looking at? And none of those things are in a live trading room. So again, I'm not picking on you, but if that's your parameter, then people are taking money from you for something that in the long run's not going to help you. That's my sense of that.
Yeah. Christine's asked another good question. Do we look for setups off the opening 5 A levels later in the session?
Absolutely.
Great question.
Great question. And guess what? That happens to be called, and it used to be one setup, Christine. And after the workshop we did in the fall, the 3-month setup workshop, and we went over this for 3 months, guys. So, you know, I'm admonishing you, Google that word. If you think you're going to get this in one session or 2 or 3 or 4, you're not. But my intention here is to give you enough meat today that you sense there might be value here. Next week, give you some value. But again, you must understand you're not going to learn that setup in 2 free sessions. If you could, it's not a very valuable piece of information. Okay? And so then what we're going to do, once you understand building a process and the idea of process structure, then I'm going to show you some setups and some ways to trade those. But the idea of finding your Bubba is adapting that to you and your trading style. And that's what we're all about in Trading Research Group. You know, there's no people here selling crap. We're all real traders making real money or trying to learn to do so. And so it's just a very different approach than the trading room nonsense that you're used to hearing and the, you know, sign up for our, you know, text message alert service. And, you know, by the time any of that happens, it's too late. It's total crap. So, oh yeah, but Jonathan makes a great point. You know, it's real tasty and they're feeding your human emotions by selling you that garbage. You know, there's a guy I was just seeing on Twitter this morning, you know, with the dark pools, you know, and it's $99 a month or $1,000 a year for his proprietary dark pool indicator. Okay, professional trader, 47 years experience. Lee, professional trader, 20 some odd years experience. That stuff is total and complete bullshit. Okay, I just can't emphasize that enough. There are no rooms or secrets or algos or black boxes or dark pools. Yes, there's something called a dark pool, but it has nothing to do with any of us. You know, if you're trying to sell 100,000 shares of IBM tomorrow, you might be playing in the dark pools. Oh, the lady on Top Step was hysterical, David. Yeah, with her FX. Buy high, buy low, sell high. Only $39 a month. I mean, I couldn't control myself. I ended up blocking her, so my comments are probably gone. But I mean, give me a break. Who the do you think you're kidding? And those of you buying that stuff, you know, wake up. This is a profession of, you know, that thing Trader Dante posted is one of my favorite things. And I've got it up in Surfing the Markets. And nothing could be truer than this thing right here, okay? and this is kind of the moral of the story with all this. And again, hat tip to Trader Dante. He's also the guy that puts up the 666 thing now and then. Welcome to the hardest game in the world. You're playing with some of the sharpest, fastest, most intelligent, well-informed, stubbornly irrational, and in many cases, unethical minds in the world. True statement. Computers are faster, traders are better, they have more money, they have better information. You are not at any advantage here unless you have a definable edge, and a definable edge is a setup under certain price conditions, given certain macro conditions, that has better than 50-50 odds of working. I won't do a setup that has worse than 80% odds of working. So that's what I look for as a scalper. I want 80%, or if I take a trade that's 65% in my estimation, I will give it almost no room at all because I just expect to be proved wrong. That's all there is to it. Okay, yeah, there it is. Thank you, Jonathan, for posting that. I appreciate it. Okay, Lee, so do we have any other questions? Yeah, I love that, Nate. It's work, exactly. You know, this takes practice. It takes study. It's a profession. You know, you're not going to do this as a side gig and, you know, take your $5,000 account and make $50,000 a year. If you think that, you're dreaming. And please don't join our group because I will disappoint you. I will tell you over and over again that you're dreaming. Now, if you learn some good setups and you're a good scalper with that $50,000 account, yeah, you might be able to do that down the road and make 50 grand a year. But boy, it ain't going to happen in the first 2, 3, 4 years. I've never seen it.
James has just asked the classic, why train when you can make money doing this on your own?
Oh, I love this. Yeah, this one comes up all the time. There's 3 reasons for that one. Number one, I'm 60 years old. I've been doing this my whole life. I have chronic health problems. I almost died 8 times. And as Catterday would predict, I don't know if I've got another one. I had a stroke at age 27. I raced professional motocross, broke my back 9 times in 6 different places. I raced cars on both tracks and the drag strip. I've been a venture capitalist in 26 different startups. I've worked for IBM and Microsoft. I don't have a lot to prove, James. So you know what? That's part of it. I want to teach others because my passion is teaching, training and teaching. If you look at my resume, and I posted a link to it, you know, I've just got to LinkedIn, I'm on there. You know, you can see what I've been doing my whole life, and this is fun stuff for me. I can't even find my, there it is. So anyway, this is me on LinkedIn. And, you know, I've done a lot of stuff, and this is the thing that's fun to me. So that's one answer. Another answer I told you during the session, James. I told you that one of the things that I do by teaching is I get better. So Christine asked about the Open 5B, and the Open 5 used to be 1 setup, and I realized trying to teach it in the fall last year that it's not, it's 2 setups. And I also realized how to use it with respect to another setup, the first hour high and low. Same thing with the ranges. So that's 2 answers. And the third is I can make infinitely more money trading than I can teaching. You know, a trading research group is as cheap as we can possibly get it. Our mission, and we state this, is to be free if we can do it. And if you look at, you know, what we are and are not, which is on our homepage, you know, you'll understand a lot more about our ethos and our mentality. This is it right here. Let me zoom back just a bit. Okay, so, you know, we look at this as a learned skill. And, you know, we don't do nonsense with trades and price levels or indicators or even suggest to you this is easy to do. I make nice money doing this when I do it well. I also love to teach. I don't make a lot of money teaching this. It costs me money to teach. So those are the 3 reasons.
I'll speak to that as well, Jeff, because it applies to me. And, you know, for me, it's your point too. It's if I educate and coach, it forces me to have a crystal clear understanding of what I'm doing, which makes me better, so all boats rise. But also, it provides for balance. You know, it's the same thing on my other software business. If I'm able to actually find some visual advantage for myself, then why should I not monetize it? But in order to make that product good, I have got to have such a good understanding of what it's doing for it to have value. And if it didn't have value, people wouldn't buy it. But it's the flip side of this question that comes up every second, every third open to the public event, which amuses me, which is people are rightfully skeptical of all the snake oil and sharks and furus in the educational space and trading room space and whatever else. Yet these same people are really eager to find that silver bullet or gold nugget, but they're skeptical about paying money for value. So if you and I didn't coach or educate, we'd have people saying, but you know, how do I learn what you do? Can I pay you money in order to get your knowledge? And then we put ourselves out there, and then people go, but why are you training if you can make so much money doing it? It's a constant circle, this question.
It completely is, and that was a great answer. And by the way, James, thank you for saying what you did. Much appreciated. And you know, I thrive for the feedback. But I'll give you one quick example. Just, you know, this is a fun one. So I taught a workshop a couple of weeks ago, and and just to be clear, if we are $99 a month, but there was a special event we did called Boot Camp Chart to Dome. And we charged $49 for that. And if you want to add it to your membership, it's $49. It was a one-time event. And I did 6 live sessions, okay? And it was for a total of about 50 people. So for the $49, do the math. And, you know, I basically made a couple of pennies an hour doing that. And I do live trading in front of people all the time, scalping. And I can do $1,000 an hour scalping the ES or the micro ES. So, you know, on what planet would I try to do this for the money? It doesn't pay well enough to do it. So thank you, Joe. That again is, you know, the thing, so, look, I have chronic health issues, and people, if you watch the recordings, you'll hear me say this regularly. There are days I do not want to get out of bed. I don't sleep through most nights because I'm in a lot of discomfort. And so if I have a session scheduled to teach, many, many, many days, that is the only reason I get out of bed. So I try to be entertaining. I try to put it into context, you know, based on my life experience. And, you know, I think there's a lot of gold nuggets here, but the admonition I have to constantly go back to is, please understand that this is not something you're going to learn in one session. And understand that if you try to frame it as something you already understand, it won't make sense. You have to try to say, all right, you know, yeah, I'm a certified technical analyst, and yeah, I've been trading for 20 years, but, you know, let's put all that aside for a minute. Let's just look at these ideas of price action and, you know, setups based on the price action and the conditions, and forget everything else, because everything else, you know, that technical stuff will be valuable as a way to filter this. But if you try to understand, and here's the key point, if you try to understand this in that framework, it won't make any sense at all, because it's the antithesis of that framework. It's not based on metrics of the past. It's not based on math of the past. It's based on what's going on right now, and that's all that matters. Okay, so let's see, any other questions? Thank you, Stephen, I appreciate that. And Stephen is a really good example. I wanna just say a quick comment. I don't think he'll mind if I mention this. Stephen is a physician. And in addition to just running TRG, I have coached a number of people. I had a trading group like TRG in 1999. It was called Dr. Jeff's Day Trade Clinic. And on eSignal platform, I taught scalping day trading based on just moving averages. Back then that worked. And I've had a couple of doctors that I've coached intensively. And it's a really good profession to compare to ours, because medicine, you have to go to school for 12 years just to get in the door. And then you have to practice. But once you are skilled as a physician, if you think about a brain surgeon doing brain surgery, he's not sitting there going step 1, step 2, it's innate. It's something, it's just built in. It's a Bubba and it's a Blink, which is another book I recommend, Blink. And it becomes second nature. But the thing that I've learned in trying to teach very successful doctors, a couple of them, I shared this with Stephen, was they're really hard to teach because they are so smart and they are successful at what they do, and they are very scientific and analytical. And the one thing that they struggle with, which is what we all do in trading, but for them it's really hard to reconcile, and for any highly trained professional, you have to reconcile that your technical education only gets you in the door, but what's going to be about the decisions, the trade you take and the trade you don't is human being emotion and fear. And, you know, a guy with brain surgery experience for 20 years doesn't open up the patient and say, God, I'm really afraid I'm going to kill this guy. You know, his mentality is, I've been doing this my whole life. I've got this. And yes, the guy might die and might not, but, you know, that's an expert. That's how an expert approaches a process that they do.
And yet these brain surgeons get hung up thinking it's rocket science or something.
You know what? So I had these two partners, and I wanted to share as an example. So they were both neurosurgeons, retired, and they were extraordinarily successful financially. I mean, you know, these guys had houses all over the place and lots of money, and they opened up $1 million each, you know, in their retirement, in their futures accounts, and they're going to trade the futures, and they wanted to learn how to do it. And so, you know, they were in my group, and then I agreed to coach them one-on-one and in person. And, you know, we had months of daily sessions, and, you know, I could not get them to understand this subtle thing. And so finally, when we went our separate ways, and totally as friends and whatnot, and one of them said to me, and you know, he said it absent the other, but the other kind of confirmed it. He said, you know, one of the things I learned in medicine is to understand what I do not know. And he said, I have learned enough from you to understand that I am not going to be good at this. And I said, you know, of all of our conversations, that is literally the smartest thing you've ever said to me. And this is a guy who said smart things every time he opened his mouth. So there's a really key lesson there. You know, it's that, and that's why the tabula rasa thing, you know, you don't need to be smart to be good at this, although it helps, but you're your own worst enemy if you don't put that on the back burner and say, okay, you know, just how simple can I make this? And so this is a really good example. You know, this was my old version, which is obviously more complex than this version. And that's what we're talking about when we say, you know, we're constantly moving forward. You know, that's what this is. We believe in progress, not perfection. As a trader, you're always learning or optimizing. So that's the moral of that whole story. So thank you, Stephen, for letting me go off on that tangent. Okay, so any other questions, comments? This is, gosh, we're going into 2.5 hours. Vimeo is going to kill me.
Yeah, I think we're pretty much there, Jeff. I think we should just wrap up and explain what's happening for the next session for those that aren't TRG members, and remind them how to
let's do that.
Avail themselves of TRG.
Okay, so TRG, go to the link. You can join us right there. You just sign up, and then Amy or one of us will immediately come out and help you find your way around. The next session is on the 2nd, a week from today. Same bat time, same bat channel. For those of you old enough to remember Batman, the original one. We will send out a recording link, but because this is a 2-hour session, it will probably take at least the weekend to render. So look for that early in the week. There will be a link in there. I will also post it publicly on Twitter and in Surfing the Markets for the next session. And that's all you have to do. And if you want to get a jump start, if you like what you're seeing, by all means, join us and, you know, start watching some of the videos. This stuff will make a whole lot more sense for you if you do that. But you're welcome to come again free next session. So did I miss anything, Lee?
No, that's it.
Okay, cool. All right, guys, thank you for coming. I hope you'll join us next week. And without further ado, we're going to wrap it up. Have a great Catterday. Stay safe. And we'll all live to trade another day.
Bye. Thanks a lot.